joins us now with his big market call. And Tom, what a segue. Bryn's saying she's not ready to call the bottom, but you certainly are.
Well, I mean, I think all of those comments actually are valid. We don't have visibility. And I do agree the first half has been a story of economic misery, but we know the market's character's changed. And I think that's the signal we have to pay attention to, that the stock market, I think, is starting to respond and anticipate a turning point in inflation. And that's very similar to August 82. That's what we wrote about to our clients today, that in August 82, CPI was still 6%, still in the biggest recession since the Great Depression. Volcker wasn't even ready to give up the anti-inflation rhetoric until October, so not for another almost 8 weeks. But the stock market turned decisively. And I think one of the key points is that inflation-driven bear market was erased in 4 months. So you had almost a 3-year bear market that was completely recovered in 4 months. And I think that's what we have to be mindful of today, that I think companies had great earnings, considering we had a huge inventory correction, a 10% rise in the dollar, and 6 months of negative GDP, and yet 70% of companies are beating, and actually positive earnings growth for the majority of companies. So I would just say I'd give performance of businesses an A+ in the face of that.
Tom, let's dig into your call just a bit. You see the S&P ending the year at 4,800, about a 15% rise from today. What's the catalyst? Because certainly inflation, at least at this point, has not died down. We're seeing PCE at a 40-year high, CPI at a 40-year high. What is the catalyst for this move?
Well, for our Funds Direct clients, we're sending an inflation dashboard that really looks at 3 types of inflation before it shows up in CPI, including the alternative data, commodities, and a lot of leading indicators. Those have all decisively rolled over. So I think when people talk about CPI being elevated, which is correct, that's the hard number, but it's already come down sharply. And in fact, by some measures, I'd actually say that leading indicators say for the next 6 months, month-over-month inflation will annualize under 2%. So, I mean, we could have half a year where people are going to start to say CPI is under 2. And what does that mean for multiples? I mean, I think that's what the 10-year and the 2-year have been telling us. And it would really be a very classic bear market move, a bear market end for the rally to be strong. I can't explain it, but I would suspect it has a lot to do with not only multiples expanding, but actually visibility improving. And if the dollar weakens and we got the tailwinds from lower gasoline and consumers, confidence improves, I just think all of this means stocks can recover pretty quickly. And I know people think markets were expensive at 4,800, but if earnings are 245 or 250 next year, I mean, it's not demanding to say markets can get to 4,800.
All right, Tom Lee with another call on inflation. I want to bring in the investment committee. Tom, I'm going to start you off nice and easy with Jim Liebenthal. He's bullish too, just not as bullish as you, but he's also bullish. Jim?
Hey, good morning, Tom. You know I'm bullish, so if I'm saying you're more bullish than me, that's saying something. Here's my question to you, and I get your research and I love it, but when I hear the comparison to 1982, what I think of is the start of a 17-year bull market that was promoted by a lot of things, not only breaking inflation, but the Reagan years, deregulation, not only here, but also abroad. I want to make sure I'm understanding you. Are you saying we're embarking on some sort of regime like that of many, many years and many other powerful forces at work, or is this just, hey, we're breaking inflation like it broke in 1982?
Jim, it's a little bit of both. I think that, the Volcker bear market, which was sort of the end of an inflation regime, but that was a 27% drawdown. We've had a 25%. And I think this is how investors need to appreciate it. When you're sort of breaking the inflation regime, markets can continue to recover to levels that are far faster than people expect. But you're right. I don't think we're going to be up 150% in 18 months like in 82. But I think the bull market that was in place because of the pandemic and the re-engineering and the millennials and the generational wealth transfer and the reshoring back to the U.S., I think those are all still intact. And I think that's what people forgot, that in this sort of 5 or 6 month bear market, investors got so gloomy, they forgot that there was a lot of underlying drivers that actually protect the economy, including the fact that U.S. households and corporates aren't even highly levered today. So I think the market is going to resume its rising trend, but it was interrupted by this huge inflation episode.
Yeah, Tom, this is Bryn. I have a question for you. Great to see you. I think that, you did great work, obviously, on looking through the tea leaves and looking out past how a lot of people can't. But where I question about the 80s is that, in 1971, the PE of the S&P was around 16. 10 years later, in 1982, it was 8. And then I think the other backdrop that gets ignored is that, the Reagan tax cuts were huge tax cuts in 1981, which took, tax rates from 70 to 50 and then a big cap gains cut. So you had that double whammy of deregulation, but these big tax cuts and Volcker. Right now, our backdrop is actually we're about to get tax increases from the Biden administration, and you still have this inflation. So I'm curious how that comes together, because I do think the big difference is that starting multiple of 8 and cutting taxes is a big difference between now and then.
Yeah, those are fair points. I think what people forget is from 82 to 87, S&P earnings actually declined. So you actually had almost 20% lower earnings 5 years later. The PE multiple went from 8, as you said, to nearly 25. And the 10-year was still around 6% by 87, maybe even 8%, so down from over 12. So you had a risk-free rate that would have argued PE should have stayed in the teens, but it went to 22. Earnings growth CAGR'd at a negative rate, yet the multiple went from 8 to 25. So I think when we think about markets embracing risk, the stock market is going to find equilibrium on PE. I mean, again, I just want to point out, S&P companies for 6 months have been dealing with negative GDP, a supply chain bullet that's been ferocious, strong dollar, lack of visibility, and they're still producing earnings growth. And to me, that's the achievement. And that's why I think multiples can go higher than they were in the 80s, because these are better businesses.
Rob, I think you got a question?
Yeah, happy client of Tom. Newedge is a happy client of Fundstrat. Tom, if we get to 4,800 by year end, as you're saying, that'd put us at 19.6 times forward earnings. And can the market sustain that valuation with the Fed going beyond neutral and still doing QT? And if so, what does that imply for 23 returns? It strikes me that it sets up a much more difficult environment, because the last 2 times we got to 20 times valuations, 18 and 20, after a melt up, markets sold off quite meaningfully.
Yeah, Rob, first and foremost, Rob, happy birthday. I think that if we go to 4,800 this year, it's a great question. Are we borrowing from the future? Probably or possibly, but it really depends on what the market's telling us at 4,800. I mean, I would say if the Fed moves towards neutral, which it is, remember, that's not a risk asset killer. The Fed is not trying to step on the neck of the stock market. It is trying to contain and manage inflation expectations. But if you look at the inflation swap market, or even market-based measures of inflation, it's really pointing us towards a 2% inflation level, meaning the Fed probably has done more than the market realizes, and the Fed even itself. And so if the Fed is cutting rates in 2023, I'm not saying that's our call, but if it is, we know that that's actually going to be supportive of PE. And as you know, when we come out of a downturn of a business cycle, PE tends to overshoot because investors look at trough margins. So could stocks do well for the next couple of years, even if we're at 4,800? Yes, but it's a lot of unknowns, and I wouldn't be comfortable saying I know the path for the next couple of years, but I do think we're going to recover much more quickly than most people expect.
All right, Tom, we have to leave the conversation there. Tom Lee from Fundstrat saying the 2022 bear market is over. Tom, we appreciate you being here. And you don't want to miss my Pro Talk with Tom Lee on Tuesday, August the 2nd at 12 p.m. We're going to go